Traders Library is proud to present the Trade Secrets video series. These instructional tapes are supported by other educational materials, including charts, manuals, and other visual aids available at www.traderslibrary.com/tradesecrets. To view these materials prior to watching the video, go to www.traderslibrary.com/tradesecrets. Taped live at the Online Trading Expo, this exciting new series is the first of its kind for traders and investors and provides tactics and insights from experts like Oliver Velez, president of Pristine.com and author of the new book, Tools and Tactics for the Master Day Trader, in Swing Trading with Oliver Velez.
If you find a stock that meets strictly the criteria and definition of an uptrend, higher highs and higher lows, your job as a swing trader is to buy every single decline. Not some of them, not a few of them, but every single one. The only question you have to answer is when.
John Murphy, president of Murphy Morris, CNBC's technical analyst for 7 years, and author of John Murphy on Chart Analysis, in High Probability Chart Reading with John Murphy.
If a stock breaks its 20-day moving average, it will normally decline to its 50-day moving average. So the 50-day becomes the next target. If it breaks the 50-day moving average, it will usually drop down to the 200-day moving average. And those are the three that I use the most frequently.
Martin Pring, internationally respected as one of the top technical analysts, founder of the International Institute of Economic Research, and author of Martin Pring's Introduction to Technical Analysis in Technical Analysis for Short-Term Traders.
You really just need to pick on 4 or 5 indicators, and that's what most people would do. I think most of the time they just pick on their favorite indicators. And what I do on my daily charts, for example, is I look at the rate of change is the number one indicator I look at.
Tony Oz, founding member of Day Traders USA and author of Stock Trading Wizard in Day Trading Wizard, using high probability support and resistance levels.
If you don't know how to write a full-blown trading plan like I have, in the Stock Trading Wizard book, what I really recommend doing is write 2 numbers. Even if you're doing an intraday trade, write 2 numbers, write your exit numbers, write your price target, write your stop loss, and write them down on paper when you trade. Because if they're written down on paper, it's easier to have the discipline to follow it. If it's in your head, it's adjustable.
Robert Deal, internationally recognized trading expert and author of numerous books, including The Strategic Electronic Trader, in The Intelligent Online Trader, Discipline, Tools, Techniques, and Technology.
That each individual stock and each individual market has 3 components: a trend component, a profitability component, and a high probability component. And what I do is I give these specific numbers and I score them, and then I have that list, remember I told you about, that pops out, that six or more securities? Then I narrow that down with this methodology to 3. 3 of the top high probability profitability trades.
Mark Friedfertig, CEO of Broadway Trading and co-author of the groundbreaking book, The Electronic Day Trader, in Power Day Trading, Successful Strategies to Increase Profits.
You probably don't want to be trading in that market yet until it develops further. Market makers aren't participating in that market outside of 9:30 to 4. Or if they are, they're not doing it out of obligation. So the markets are less liquid and a lot more risky and a lot more subject to manipulation for that matter. So outside of 9:30 to 4, we don't really have a true market yet.
The Trade Secrets video series is a truly comprehensive series for traders, featuring these information-packed videos. All of these tapes and over 3,000 other investment-focused products are available on the Traders Library website at www.traderslibrary.com. That's www.traderslibrary.com. Go there now and sign up for the weekly email specials that will get you free books, free videos, free audios, and information on new products and upcoming conferences. or call 1-800-272-2855 extension T188. That's 1-800-272-2855 extension T188. Traders Library, providing solutions for investors for over 10 years. Swing Trading with Oliver Velez, president of Pristine.com and author of the new book, Tools and Tactics for the Master Day Trader.
Ladies and gentlemen, there's been a great deal of debating as of late going on connected to whether or not swing trading is safer than the traditional form of day trading. And I find this argument quite interesting simply because my views are very, or somewhat vastly different from, I think, a lot of the individual gurus in the industry. I have not only different views in terms of what swing trading is, but I also have different views in terms of what day trading is as well. Just so that we open up on the right footing and we have our terminology down and uniform, I'd like to talk to you about what my definition of swing trading is. Swing trading, of course, in my opinion, is a style of day trading. It is a subset of a broader category called day trading. It involves holding a stock anywhere from 2 to 5 trading days. Now, oftentimes a swing trade can last as long as 10 days in my book, but on average, it's about a 2 to 5 day trade. What's interesting about this style and philosophy is that it helps to capitalize on a market niche that, in my opinion, is largely overlooked by some of your bigger players in the market. Consider this. The 2 to 5 day time frame, as I've explained many times on CNBC and various other mediums, is too short for those very frenzied schizophrenic day traders who typically never hold a stock overnight. And at the same time, it's too lengthy for those traders. It's too short for those very large institutions to take advantage of. So two of the most dominant market groups in existence today are really not involved in this 2 to 5 day time frame. The big elephants, the institutions, cannot maneuver quick enough for a 2 to 5 day time frame and ask your traditional day trader, what, me, hold a stock more than 5 seconds? So here we are, the individual astute swing trader operating in this void is devoid of competition. Basically, he or she is operating in a time frame or a pocket in the market that really only has as participants ill-informed market players. And that spells opportunity. You guys have heard me say it many times before, that successful trading is nothing more than the art of finding two groups of ill-informed market players. Those willing to give up their merchandise to you too inexpensively, and those willing to take it off of your hands at a price you know is too expensive. So in reality, we are taking advantage of ignorance. To be more specific, we are taking advantage of two emotions at work. Fear, accentuated by pain, and greed. Those are the two emotions we are taking advantage of. I am a sole and firm believer of the fact that we do not trade stocks. We trade people. We trade against two dominant emotions, fear and greed. And to really drive this point home, it is interesting to note that there are only three emotions at work in the market, period. And if you become a master at pinpointing when one emotion turns into another emotion, you've got the game conquered. The three emotions are, of course, fear, greed, and uncertainty. When the dominant market players are uncertain, stocks tend to, or the individual stock in which they are uncertain, tends to do what we call consolidate, go nowhere, basically vacillate between a relatively predictable price range. When fear is the dominant emotion shared by the dominant group in the stock obviously goes where? Down. When, of course, the majority of the individual players in an individual stock are experiencing greed, that's obviously when stocks are rising. Keep in mind, please, that the equity markets, the stock market, is a wealth-creating mechanism, very much unlike the futures market. The futures market is really, truly a zero-sum game. Some would actually call it a minus-sum game when you add commissions to the factor. But what that really means, ladies and gentlemen, is that the futures market is a wealth-robbing mechanism, while the equity market is a wealth-creating mechanism. And this is incredibly important to understand before we actually delve into some of the material I prepared for you today. And I'll explain why. In the futures market, everyone puts in or contributes to the kitty. If we were all futures traders in the same vehicle, we'd have to pull our money out, each one of us, and add our money to the kitty. What this means is that whenever an individual wins, he has subtracted wealth from the kitty. In other words, in order to have a winner, we must have a loser. Now, a lot of people erroneously assume that this applies to the equity market. It does not. Not always. See, the futures market takes wealth away from someone else when you win. The equity market creates wealth out of thin air. Let me go over a scenario for you. I buy a stock at 10. Sell it to you, sir, at 12. You buy it at 12. Sell it to this young lady at 14. You buy it at 14. Sell it to this gentleman at 16. Who has lost in that scenario? No one. You take it at 16. You sell it to this gentleman right here at 18. You take it at 18. Sell it to this woman in the back at 20. You take it at 20 and sell it to this gentleman here at 22. No losers. You take it at 22. You sell it to this man at 26. You take it at 26, sell it to this man at 28. He takes it at 28 and sells it to 30. We've got a 30. This gentleman takes it at 30 and cannot find a 31, a 32, a 33. Cannot find a 30 and a quarter. Cannot find a 30 and an eighth. This gentleman is looking for his greater fool, but there is no greater fool. So then he says, he realizes that I've actually potentially made a mistake. And now what was greed that incited the individual to buy at 30 now starts to convert itself to the emotion that we term uncertainty. From uncertainty, fear starts to creep in and sit right on his shoulder. And fear says, do you remember the last time you hung around? So what happens is this individual says, yeah, I do remember, and it wasn't a pleasant experience. So he starts looking for someone to take him at 28. He sells it to someone at 28. Someone at 28 looks for someone at 29, no longer being able to find someone at 29, feels he's made a mistake. His greed has turned into uncertainty as well, and now he's selling at 26. Someone takes it at 26, sells it at 24 because they can't find someone at 25, and the process reverses itself. Our job is to find out. Our job is to be able to pinpoint when that last person at 30 has trapped himself. That is the guy that I want. Because what I want to do is squeeze his stock away from him. I want to create such a panic in the stock that it will cause him to search out exits from the theater that he just entered, the stock he just entered, at 24.25. I want to incite this individual to sell his stock to me at the very moment he should actually be thinking about buying more. The same on the reverse side. So this is true professional trading. And swing trading offers, in my opinion, the ability to take advantage of that switch from greed to uncertainty to fear to uncertainty to greed to uncertainty to fear to uncertainty to greed over and over again in an easier fashion than your typical day trading does. Now, I believe swing trading is a lot safer than your traditional day trading simply because the individual has more time to filter information. The individual has more time to make informed decisions. The individual has more time to assess the environment. And under those circumstances, more intelligent decisions can and more than likely will emerge. I find that the typical day trader, especially the particular micro trader without a great deal of seasoning, cannot act intelligently when he has a fraction of a second to do so. I also feel that swing trading is a lot safer than day trading simply because it lends itself to diversification, which in many cases micro trading does not. Because in micro trading you are going after exceptionally fractional small gains, you have to make up for those small gains and the commissions that are levied against you with big size. So you are, in many cases, piling into one play for a few seconds to a few minutes with the hope of capturing a small micro gain. That takes a precision, a level of precision that most people do not ever obtain, because that type of precision, accuracy, is only obtained through a long period of experience in the market. So swing trading lends itself to diversification. It is also safer because swing trading lends itself to playing that style with a small account. In day trading, in order for me to put the odds in my favor, even as a talented market player, I have to play big size, therefore I have to have a big account. But swing trading, I can do fractional amounts because I'm capturing larger gains, which have a greater odds of overcoming all of the things that work against us, like commissions. So are you following me on this? I'm hoping that I'm convincing you that swing trading is far superior, specifically for the individual who is just kind of getting into playing the markets actively. All right, so with that foundation being laid, I'd like to move into some of the material that I prepared for you. Unfortunately, this is probably the largest group of any session at the Expo this weekend, and I'm absolutely delighted. What is unfortunate because of this, I do not have enough of these materials to pass around. I expected about 100 people, and there's about 600 people here. So we are going to auction my materials. No, I'm only teasing. I've got 100 pieces, and I'm debating whether I hand them out to 100 people or not, or whether I just allow you to email us and we'll get you the packages. But at any rate, I will say this, that the material that we're going to go over today is a very good chunk of the course that I sell all over the world, that I conduct all over the world for $3,500. I have not doctored it. I have not watered it down. It is exactly what I deliver for that price. It, of course, is not all of that. in reality, it's a small portion of the course, but it is the heart of the course. It is the core. And my objective today is to make sure that on Tuesday when the market opens, you know how to at least spot opportunity from a swing trading perspective. And I am willing to actually guarantee that you look at the markets entirely different on Tuesday. All right, shall we get started? All right. All right. Okay, let's go to the first material. Let's go to the next. Okay, the first part of this material, I'm going to go over, obviously covers the, that's actually backwards. I'm going to cover the foundation. It's very important that we all understand this part before I move into the other part, because everything we talk about from here on will be based on this foundation. You've got to get this straight, and I will make sure that we do not move on until you get this part straight, okay? First of all, I think it's important for us to understand some of the concepts of candlesticks. I will tell you that our approach to the markets is a technical one. Many of you who know Pristine.com and the services it offers are very much familiar with that. We approach the markets from a technical point of view, not a fundamental point of view. It is our philosophy that charts do not lie. CEOs lie, annual reports lie, accountants lie, numbers lie. I was an accountant. I've made numbers lie. All right? Charts do not lie. You know why? Because every single transaction that is made has to show up on the tape. I am watching through the charts the footprints of every single piece of money. Every time a CEO puts his money where his mouth is, it shows up on the chart. There are times, obviously, where a CEO can get on CNBC and talk so positively about his company while his grandmother, his girlfriend, his wife, and all the way down to the janitor in the firm is dumping the stock. But yet, those activities will show up on the chart. The charts are very much like the doctor's x-ray, which gives him a deeper insight into his patient. Well, stocks in the market are our patients, and charts show me the deeper aspect of what the players are doing. All right? With that being said, charts are not charts for me unless they are in Japanese candlestick form. How many people are familiar with Japanese candlesticks? I strongly urge, that's quite a number, and I'm very glad to hear that. I strongly urge that if you are not, that you pick up Steve Nissen's Japanese Candlestick Charting Techniques book. The title is Japanese Candlesticks Charting Techniques. It is written by Steve Nissen. It is absolutely the only book you ever need on candlesticks. In my opinion, it is the Bible as far as candlestick form. Now, there's a very important reason why I feel that charts should be viewed in candlestick form, and it is as follows. Simply because that it is visually easier to determine who's winning the game. Every single day is nothing more than a battle between the buyers and the sellers, the bulls and the bears, the haves and the have-nots, all right? The informed and the ill-informed. But broken down to its essence, every day is nothing more than a struggle, a battle going on between two dominant groups, buyers and sellers. The key to playing the market successfully is finding out who's winning the majority of the individual battles, because that group is winning the war. And that group is what I term the Goliath in the market. So if, for instance, I can determine that of the past 10 days, 7 days were won by the buyers, then who's the Goliath? The buyers. And who do I want to side with? Goliath, not David. If this were the Bible, it'd be David. It's the market. You bet with Goliath. All right? All right. So, candlesticks show us very clearly, who's winning the day, and it does it as follows. The most important price of every single bar, every single day, is the opening price. I want you to sear that into your brains. The most important price of the day is the opening price. The second most important price of the day is the closing price. Open and close. Now, we determine who won the day by determining where the close is in relationship to the opening price. So the opening price, for instance, let's say is at $40. If the stock closes above $40, the buyers won the day. If the stock opens at 40 and closes above 40, the buyers won the day. If the stock opens at $40 and closes for the session below 40, the sellers won the day. I want you to regard the opening price as the starting line of a race. And I want to see whether or not the stock ends behind the starting line, telling me sellers won, or above and beyond the starting line, telling me that the buyers won. Candlesticks show that very clearly. Do I actually have a pointer up here somewhere? I do not. Okay. What I love about candlesticks, if we look at the second bar from the right, we will see that in candlestick form there is a fat part of the bar, a fat light-colored part of the bar. And above the fat parts, we have what we call wicks, or little stems. The fat part of the bar represents exactly what I explained to you, the difference between the open and close. And when the bar is light-colored, that means that the bottom of that fat part is the open, and the stock floated upward to close above the opening price. So the cylinder part, the fattest part of the bar, if it's light-colored, means the buyers won the day. Of course, if we were to go to the fourth candlestick bar to the right from the left, we see a very dark, ugly, nasty, long bar. This bar tells me that it was dark for that stock all day long, virtually. That the stock opened relatively close to the high of the day, and almost from the opening price, the sellers dominated the action and just kept pushing the buyers all the way down until they closed the stock for the day fractions off the low. So the dark bar tells me sellers have won the day. Make sense? The wicks on top of the high of the session, the wicks on the bottom of the close. Of course, on the first bar to the left, we find that there was an equilibrium between the two groups, an equilibrium between the buyers and the sellers. All right? No one really won that day. Okay. The bottom row are reversal bars, which basically represent cleanup by one group or the other. In other words, the first bottom bar to the left tells me that the stock opens, let's say, at $40, traded as low as, let's say, $38, and at a point around 38, the buyers just roared back and brought the stock all the way back to the finish line. Write this point down. The last side to have control is the winner. In this case, the last side to have control were the buyers. All right? The stock initially opened, dropped, then ended the day closing at the same price. All right? In the second bar from your left, you have just the reverse. The stock opened near the low of the day, rallied where the buyers were in control for a specific period of time, and then all of a sudden the sellers retook the market and knocked the stock all the way back down to the opening price. In this scenario, in a very general way, the sellers have won the day because they were the last ones to be in control. Let's move on. This brings me to another one of our foundational blocks. And it may sound very simple, guys, but I will show you in very short order how powerful this very basic concept is. There are only three things a stock can do: go up, go down, and go sideways. That's it. There is no other movement possible. So what I'm really saying is that there are primarily three dominant trends in the market: uptrends, downtrends, and sideways trends. An uptrend is defined as follows: a series of higher highs and a series of higher lows. In other words, each successive rally takes out or supersedes the prior peak from the prior rally, and each drop falls far short of the trough of the prior drop. This is a stock in an uptrend that is completely dominated by which group? The buyers. I want you to keep the definition in mind because it's going to become very important as we move forward. The definition of a downtrend is just the reverse: a series of lower highs and lower lows, meaning that every single time the stock rallies, it is a feeble rally that falls far short of the prior peak. And every single time the stock gets driven down, it falls deeper and lower than the prior drop did. This is a stock that obviously is in total control of by the sellers. And then we have the sideways trend, which is really nothing more than relatively equal highs and relatively equal lows. There is a tug of war going on between both groups, and neither of the groups is winning. Now, the key word in that definition is relatively equal highs and lows. We don't want to be too anal retentive about the highs and lows. Okay? So, there are only three trends: uptrend, downtrend, and sideways trend. And these three trends make up every single movement in the market. There's only three. If I can teach you how to play with great degree of accuracy each one of these three trends, I can teach you how to cover yourself in every possible market environment in existence. All right? And that's the key. Now, in an uptrend, if you find a stock that is making a series of higher highs and higher lows, meaning that every high is higher than the prior high, every drop is higher than the prior low, your action as a swing trader is to buy the very next decline. I want you to understand this because it is critical. If you find a stock that meets strictly the criteria and definition of an uptrend, higher highs and higher lows, your job as a swing trader is to buy every single decline. Not some of them, not a few of them, but every single one. The only question you have to answer is when. Not if, when. If you find a stock that is in a downtrend, meaning that it is making a series of lower highs and lower lows, you obviously are in a very serious downtrend. I am telling you that I don't care what the earnings report says. I don't care what some high-paid Wall Street analyst with frayed shirt sleeves says. That every single rally in the stock is nothing to get excited about. As a matter of fact, every single rally is a sellable rally until that pattern or that definition ends. If you are in a sideways trend, meaning relatively equal highs and relatively equal lows, you as a market player can play both. You can buy the declines and you can sell the rallies. So let me go over this again, guys. If you find a stock that is making a series of higher highs and higher lows, that means that you are in an uptrend. If you are in an uptrend, you can buy every single decline. Your action is to buy the dips. If you are in a downtrend, and the stock is making a series of lower highs and lower lows, that obviously means you're in a downtrend. If you're in a downtrend, your action is to sell every single rally. And when I say sell, that means that you can go short, or if you happen to be long in that stock, you'll want to get out on the very next rally. If it's a sideways trend, you as a trader can do both. You can buy the dips and sell the rallies, buy the dips and sell the rallies. The only question is when. Now, guys, this may sound very basic to you, but I will tell you that this very simple concept gives you the ability to perform better than 98% of the so-called professionals out there or the talking heads on television programs like CNBC. The $64,000 question every single day in the market is, how do I know when a decline is an opportunity or when a decline is a reason for me to run for the hills? Isn't that the prevailing question? Aren't entire television shows dedicated to that one answer? One guy says you should buy because it's going higher. Another guy says no, the stock's uptrend is completely shot. There's no more momentum. Two guys battling on this one question. Is the decline in the stock an opportunity to buy, or is it the first sign of trouble? This concept answers the question. If the stock has made a new high and the decline is falling from a new high, that decline is buyable. It is not a reason to take flight. It is not a reason to get nervous. It is a buyable decline. The same in reverse. Now, guys, let me tell you this. With this one simple basic concept, you now have the ability to hold your very own CNBC buy, hold, or sell session. I promise you. You can be a guest on CNBC, and they can take the phones to John from Wichita. John from Wichita says, my broker says I should buy WXYZ. Do I buy it, sell it, or hold it? And you could say, well, sir, I've just taken a quick look at the daily chart of WXYZ, and I see a very powerful series of higher highs and higher lows. Each time the stock rallies, it is strong enough to take out the peak from the prior rally. Each time it drops, the sellers are incapable of bringing it as low as they did the last time. This is, in fact, a very strong stock. So that your job then, John from Wichita, is to buy on the very next decline. Another individual can call up after you've been thanked by John and say, you know what, my broker says that I should be buying ABC. And you say, well, ma'am, the first thing I want you to do, because I've just taken a look at the daily chart of ABC, the first thing I want you to do is to fire your broker, all right? Because this stock is in a severe downtrend. Every single time it rallies, it's a feeble rally that is incapable of coming anywhere near the prior top. And every time the sellers take it down, they take it down deeper and further. This stock is being dominated by the sellers. And I suggest that if you happen to have bought already, that on the very next rally you get out. If you haven't bought, stay away from the stock until that pattern changes. I will tell you that this is the prevailing question in the market. And I'll show you precisely how very nicely it can work to your advantage. Obviously, very quickly, this is a real-life, live uptrend. It is certainly not as neat as my drawing. That's the fault of the chart, not mine. Each high, as you can see, I have them numbered. I'm not quite sure if you can see that very clearly, but I have them numbered. Each rally takes out the high of the prior rally, and each decline, for the most part, takes out or fails to come anywhere near or it fails to break below the prior decline. Let's go to the next. Here's an example of a real life downtrend, right? If you'll notice, especially starting from peak number 3, you'll find that every single drop falls significantly lower than the prior low. Sellers are just in control all the way down. And then they take a break, and the buyers bid the stock up a little bit. Buyers can also be short covers. But the rally is a feeble rally that does not even come anywhere near the prior peak, and then we do nothing more than resume the decline again. All right? As you can see, that's obviously a series of lower highs and lower lows, making a very sharp downtrend. Here's a live example of a sideways trend, relatively equal highs, relatively equal lows. All right? Making up a sideways trend. If you look at the number 4 to the left, that is a downtrend. All right? That is the picture of pain. Can you hear them? One, the sideways trend is the picture of uncertainty and or ambivalence. It is like after the period of pain comes a period of disinterest and comes a period of uncertainty as well. All right? So in many respects, after fear, you have uncertainty. After uncertainty, after fear, uncertainty, you then kick off into another phase of greed. And that's typically the cycle. You have fear, uncertainty, greed, uncertainty, fear, uncertainty, greed, uncertainty. And of course, greed is what trend? The uptrend. Fear is the downtrend. Uncertainty is the sideways trend. You've got the entire market covered. Let's move on. Now, here we come to some of the mechanics. And it's very important for you to get this down because this is the key to my firm's entire profitability on the trading side. This is the central setup for virtually every single one of our swing trades. This right here. This is the most important page I've brought for you. Basically what we are looking at, I want you to imagine those 3 bars as being 3 consecutive down bars. Now, I want to define down bars because it's not the down bars in the traditional sense. This setup is has the following criteria. I would like to see, after the stock has made a new high, I want to see a temporary period of pain. I want to see this gentleman buy the stock at 30 and not be able to find someone above him. Now I know we are about to kick off a temporary period of pain. And I want to see pain last for 3 to 5 bars. Write that down. After a new high, I want to see pain last for 3 to 5 days. 3 to 5. I've been trading for 13 years, and I will tell you that over 13 years, my partner Greg and I have discovered that when stocks are in uptrends, that almost 90% of the solid uptrends rebound after 3 to 5 consecutive days to the downside. If they have made a new high, all you have to do is wait in the wings for 3 to 5 days and then step back up to the plate and then find someone who has sat through pain for 3 to 5 days and you say, "Sir, is there something wrong? Can I help you? Is that stock causing you trouble?" I'll take that. I'll take it all, by the way. Oh, no, don't mention it. All right? So the idea is that someone has actually bought at 30 and watched and sat through pain. Day 1, they had a headache. Day 2, they had a migraine. Day 3, they cried on their spouse's shoulder. Day 4, they just simply could not take it anymore, called up their broker or pressed the sell button and said, "Get this piece of junk out of my life." And I'll say, "I like junk. I like to take the junk. I take all the junk after 3 to 5 days." All right? So, but I want to now go deeper and to give you more detail. It's not just 3 down days. I'm specifically looking for 3 to 5 consecutive lower highs. That is your number 1 criteria. 3 or more consecutive lower highs. So, if the top at 30 came on Monday, I want Tuesday's high to be lower than Monday's high. I want Wednesday's high to be lower than Tuesday's high. I want Thursday's high to be lower than Wednesday's high. Get the concept? We stair step down. All right? Once I have 3 or more, what I also would like to have in an ideal world is 3 or more consecutive bars where the stock opens near the high of the day and closes near the low of the day. Do you understand that? That not only 3 or more consecutive lower highs, I would like, in the best of all worlds, to have that combined with each of those days having an open near the high of the day and the close near the low of the day. What does that tell me? That the sellers have created pain, solid pain, for 3 steady days. There was no break in the pain. None. The stock opens near 40, near 30, closes at the low of the day. Opens there the next day, closes at the low of the day. They do not give them even a brief moment to breathe a sigh of relief. I want the pain to be severe. Now, I do not need that criteria. I would like that latter criteria. But the criteria I absolutely need is 3 or more consecutive lower highs. If I have both, I pick up my size on the play. If I have one, I play my normal size, 3 or more consecutive lower highs. Now let's move this up a little bit for me, Joe. And once we have the criteria, here's our action. Once the stock has made a new high, and once it has experienced 3 or more consecutive lower highs, my job now is to buy the stock the very moment, the very instant the stock trades above a prior bar's high. Follow me on this. This is the key to huge profitability in the market. Once the stock has made a new daily high, I sit back and a new high, I sit back in the wings and I wait for 3 or more, it doesn't have to just be 3 or more consecutive lower highs. Once I've got 3, I start tracking highs. If the third lowest high is Wednesday, on Thursday, I say I buy if it breaks above Wednesday's high. If it does not break above Wednesday's high on Thursday, then I say on Friday, I'm going to buy if it breaks above Thursday's high. I keep tracking the highs. Do you understand? Once the stock, the very next time the stock breaks above a high, I buy the stock instantly and place what I call pristine insurance policy under, which is a stop loss, under the current bar's low or the prior bar's low, whichever is lower. Am I losing anyone? Yes. Once I buy the stock, once the stock trades above a prior bar's high, I enter. Now that I've entered, we all, as business people, need insurance because we don't live in a perfect world. That insurance policy is a stop loss. Once I'm in, I will place my stop either under the current bar, which is the same day that I bought the stock, where's the low, or I will place my protective stop under the prior bar's low of the day, whichever one is lower. I am looking for the lower of the two. That will be my reference point for the line in the sand that I draw. You see, every market player needs to draw a line in the sand. You need to mark off a point at which you are not willing to go beyond. All right? The ostrich approach in the market does not work. All right? We need to draw a line that says if the stock does not perform and it hits this line, it gets eliminated. You see, every single stock I buy, I look at as my employee. It either has to perform or it gets fired. And that line is basically telling the stock, you touch this off and you're out of my life. And you move on to the next. Okay. Here is a sample of this strategy at work using Chase Manhattan Bank. Hopefully you guys can see this clearly. But what we have on the far left of the chart is a rally to make a new high. Once the stock has made a new high, I am waiting for 3 or more consecutive lower highs. That's my only strict criteria. I'd like 3 dark bars, but I don't have to have that. I do have to have 3 or more consecutive lower highs. If you look where I have the number 1, I don't know if someone can get me a pointer. That would be fantastic if I can grab one. But we have 3 or more consecutive lower highs. It is at the arrow that after I have that criteria, the stock trades above a prior bar's high. Once it does so, I enter with a stop below the current day's low or the prior day's low, whichever is lower. In this case, it's the prior bar's low where the red line is drawn, and the stock basically takes off to a new daily high. Yes. That would be fantastic. Yes. Would you guys mind passing that up to me? Thank you very much. It's better than nothing. Make sure I return it. I certainly will. Okay. Thank you very much. So if we look very carefully, let's bring this down. Can we bring this down a little bit? Here's my buy point. The stock reached a new high here. Those of you who have listened, those of you who actually have listened to some of my talks throughout the expo, I'm a very big believer in tails. The tail at the top of this move indicates that I found the sellers. I found the individual who bought at 30, all right, figuratively. Now the stock experiences 1 lower high, 2 lower highs, 3 lower highs. I've got my 3. Now I start tracking highs. My buy is on the next day if, in fact, it manages to trade above that high. Once in, I am placing my protective stop below the current bar's low or the prior bar's low, whichever is lower. In this case, it is the prior bar's low. I've got my insurance policy in place, and now I'm filling out my bank deposit slip. Now, prematurely, of course. Now, profit taking. If we are dealing with stocks that are making higher highs and higher lows, and the prior high is $4 away, what's the minimum profit objective you come up with? $4. Because if we are in fact playing an uptrend, the odds suggest that the next swing will break above the prior high. So my prior high serves as my minimum profit objective. Minimum. We teach all of our traders that once a stock breaks into a new high, meaning that once it takes out the prior high is here, I buy here. Once the stock takes out that prior high quite nicely, I flip into sell mode. The public is taught to buy new highs. The professional is taught to sell new highs. The professional needs a rush of amateurs coming in on new highs so that they can get out on new highs and then step back and get back in line and wait for pain to start again and start the process again. So hopefully you're following this. It is the professional approach. This strategy forces you to come in right at the end of the cycle called pain, and it forces you to exit right near the high of the cycle called greed. You see, we want to sell when it becomes obvious to the world that this stock is now strong. We want to buy when it's not obvious to a great many people that the stock has finished its period of pain. Yes, sir?
Is there a provision for not leaving too much on the table once it breaks the previous high?
Is there a provision for not leaving a lot on the table? Meaning that if I start going into sell mode once the stock moves to a new high, isn't it possible for me to leave a lot of money on the table? Absolutely yes. And as a matter of fact, the more professional you become as a market player, the more you'll leave on the table. It doesn't sound logical, but the more professional your trading becomes, the more money you will leave on the table. You see, novices are the ones that can truly speak of grabbing $40, $50, $60 and a score. Professionals think like this. If 1 out of every 10 trades, let's say 1 out of every 10 trades will rally $10 or more. Let's just use that as an arbitrary number. 1 in every 10 of your trades will rally $10. Let's say 3 in every 10 trades will rally $4. Let's say 7 in every 10 trades will rally $2. Let's say 9 trades in every 10 will rally 75 cents. What do you think the professional will do? He will take the 9 wins out of every 10 trades every single time, because all he has to do to make up the difference is pick up the size. He will go for accuracy over the gamble, because he does not know of the 9 trades in the first scenario that does not work, whether 1 or 2 or 3 of them will open down $20. He does not know how much he's going to lose on the 9 trades. But he does know that under the latter scenario, I can win 9 times out of 10. I have 2 things I need to do: increase my size and increase the frequency of my activity. This is a far more professional approach. I have stopped fighting my number one problem. I have curtailed my number one problem as a trader. We all have them. My fault as a trader is that I take profits too soon. I love to ring the cash register, all right? And part of that was built into me simply because when I first started in this business, I either made money or I didn't eat. So when I had it and I was hungry, I had to take the game. And this has been ingrained in me, and I struggle with this problem, for lack of a better word, to this very day. I leave zillions of dollars on the table because I take profits quite quickly. And for years, I battled and tried to conquer this problem. And what's interesting is that there was a constant battle between 2 demons. One demon would sit on my left shoulder. The other demon would sit on my right shoulder. And the one demon on my left shoulder would say, "You know, you always do this. You've got a little tiny profit in your hands, and you always let it go, and here's going to be another time you're going to let it go and the stock's going to rock." And I say, "Yeah, you know what? That's right." Then the other demon says, "No, you remember the last time you tried to hold on for a bigger profit? You did it at the wrong time, and what happened? You lost big, right?" And there's this constant battle between these 2 sides. And invariably, when I decided that I'm going to go for the bigger game, that was the time not to go for the bigger game. So I helped solve part of this problem by doing the following. Instead of trying to pick one demon over the other, I realized that both demons are with me forever. So I tried to make friends with both of them. I said, "You know what? Instead of trying to satisfy one over the other, I'm going to satisfy both of you. I am going to take some now, so now get off my left shoulder, and then I am going to keep some for a bigger gain. Now you get off of my shoulder." And so this created the concept of what we call in our organization the incremental sell. I am not smart enough, even after 13 years of trading, to know where the top is. So what I do is I buy and I sell in parts. I may buy 1 lot and sell in 3 parts. In other words, once the stock breaks above to a new high, I sell 1/3. If it goes higher, I then dish out another 1/3. It continues to go higher, I dish out another 1/3. Remember, as the stock moves higher, I am getting closer to what? That individual who buys and can't find another buyer. So I do not want to be stuck at the top with that individual with all of my merchandise. If I do get stuck with that individual, I want most of my merchandise to have already been sold, and I only want to be stuck with a smaller amount. So once the stock breaks into a new high, I sell incrementally. Now, this may not be appropriate for a lot of you, but it is a very professional style of market play. It's also a commission-generating thing, all right? And, of course, if commissions are a very big factor in your progress, then you have to, at least until you get seasoned, stick with the buy here, sell there. All right, guys, on the second rally, we make a brand new high. Once it makes a high, I step back. I'm out of the stock already. No pain experienced, by the way. I have not sat through 3 days of the stock not doing anything. I have not sat through 3 days of the stock going in the opposite direction, giving me migraines. I have captured a pocket of time in the stock, a sweet spot, and got off. Now, I'm walking right down to the bottom floor again and waiting for the stock to come to me. The next time it experiences three or more consecutive lower highs, I'm right back in there tracking highs. It is at arrow number 2 that I get my second buy signal. Once I'm in, I place a stop below the current bar's low or the prior bar's low, whichever is lower, and voila. Once the stock moves to a new daily high, or once it breaks above the prior high, I am in sell mode. In parts. Off again. Yes, sir. It's actually, to be very honest with you, very arbitrary in my case. I've watched the market very closely, and I use other factors like level 2 activity and things of that nature. But what you can do, this is the strategy you take. You say to yourself that I am going to take part of my profits now. I'm going to take some home for the kids. Oh, thank you very much. Thank you very much. I am going to, do not let me forget this. I am going to take some home for the family, put it in my pocket. Now, psychologically, you're a winner. You're no longer on edge because it's in your pocket, and you're also still in the game. So now, figuratively, you can sit back, put your feet on the coffee table, and tell your individual stock that you now have a partial play in. You can tell it. You say, you know what? You've just been hired to make me wealthier. You either deliver or you get fired. You will never, ever let that remaining lot go into negative territory. It's free. This is free at this specific point. All right? That's the strategy you take. And what you can do is come up with your own system. Every extra $1, I sell another. Or every extra $2, I sell another. But I will never let it drop below my entry price. All right? You can also use a trailing stop method, meaning that once you sell, you can place a stop under the low of the prior bar. So it's Thursday, your stop is under Wednesday's low. It's now Friday, it's under Thursday's low. It's Monday, it's under Friday's low. And so forth and so on until the stock takes you out. Or until the stock experiences what I call a novice gap. A novice gap is a stock that gaps up significantly higher than the prior night's close after the stock has already run for 3, 4, 5 days in a row. That is a novice gap. That is a gap that is basically being created and driven by people who do not know what they're doing. People who buy at 30. Let's move to the next one. Yes, sir.
The wild swings that happen at night, markets close and the after-hours trading is going on. Has that changed any of your style of buying and selling and setting stop losses and so on?
Well, the question was, is after-hours trading and some of the wild vacillations that happen during that period, does it alter this? Actually, it doesn't. What that does to the astute market players, it does nothing more than create additional opportunity. For instance, let's say you throughout the day have bought a swing play based on this criteria. It's made a new high. It's experienced 3 or more consecutive lower highs. Here's the new high. Lower high, lower high, lower high. I'm now tracking highs on this day. This stock fails to break above that high on this day, I bring my alert back down. It is on this bar, the first bar, that manages to trade above a prior bar's high after I've got my criteria. So my entry price is on that bar. Now, let's say that came 10 minutes before the close. You were going about your business, doing your work. You have, let's say, a platform like the Executioner, and you have let technology work for you in this case because you say, you know what, I'm going to buy this stock if it takes out the prior bar's high. I don't have to watch it. I will place an alert at the prior bar's high, and when the stock hits the high, it'll alert me 1 tick prior to breaking above the high, or 2 ticks prior before it breaks the high, what have you. Boom, 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 you get your alert. Now you pull up the stock. You may want to check some other things like overall market internals and things like that. All systems go. Stock breaks above the high, you're in. Now you place your protective stop, which is typically on NASDAQ in particular, it can be a mental stop. It doesn't have to be an actual stop. But you notice now the closing bell has occurred. 15, 20 minutes later, you see some wild bid in the stock, $4 higher. On the same stock you bought 10 minutes before the close. This could be a mistake, or it could actually be driven by some aftermarket news. Instantaneous $4 gain if you hit the bid. A lot of times, because we are buying, when this drop is a temporary period of pain, keep this in mind. Market makers are squeezing, specialists are squeezing shares out of the hands of weak holders. And then they're gobbling it all back at this point in this area and ramming the stock back to the upside. We are jumping on board the stock the instant fear and uncertainty turns to greed. I want to buy the beginning phase of greed and sell somewhere near the end of the greed phase. Here's a period of uncertainty, and after a period of uncertainty, the stock continues. This is obviously another strategy, which is a breakout strategy. But oftentimes, that excessive volatility will work in your favor. I tend to try to ignore a lot of the other after-hours activity simply because it's noised by a lot of small-time players still right now. All right, let's move to the next. Yes? If it's down 4, I would tend to ignore that, but what that would ignite from me is some research in terms of a negative news item maybe having been leaked or something like that. But remember, things right now are vastly exaggerated in after-hours trading right now. Until more liquidity comes into those periods, I tend to believe that one should ignore what is happening until the next morning because things can radically change. Let's move to the next chart. Power trading combos. Guys, this is the heart of the thing. We have the foundation down now. Those of you who actually follow our services, and certainly students of our seminars or what have you, certainly realize that we are very big combination people. I want to find one specific event that happens with a high degree of accuracy over and over and over again. Then I want to design a strategy, a technique to exploit that pattern, that event that happens over and over again. We've done that already. The pattern is new high, 3 or more consecutive lower highs, buy once the stock breaks above a prior bar's high. That's the setup and the strategy. All right? Now, that's not always good enough for me. I like that which is reliable in and of itself. I want to combine that with other events that actually strengthen the reliability. All right? I will tell you that what you have now with the new high, it sounds simple, guys, but I'm telling you it is powerful. New high, after new high, 3 or more consecutive lower highs, buy once the stock trades above the prior bar's high. That one tactic alone is enough for you to make a living in the markets. I have traders that only do that. And it's also a tactic, because it's based on psychology and nothing else. It is a tactic that can be used in any time frame. 5-minute, 15-minute, daily, weekly, monthly. It doesn't matter. We are playing people, and people are the same in the 5-minute time frame as they are on the weekly time frame. The moves are just bigger.
So you're saying the new high doesn't have to be the 52-week high?
Right.
The high for the month.
That's a very good point. The new high does not have to be a 52-week high. It doesn't even have to be a monthly new high. It only has to be a higher high than the last peak. That's what I mean by a new high. Excellent question, sir. The very best, no, daily. This is assuming we are looking at daily charts. All right? What is most interesting is this fact, sir. Keep this in mind, that the very best plays come from declines off of monthly new highs, meaning this is the highest price the stock has made in 30 days or more, or 20 days and more, which is obviously a physical month. All right, let's look over. So now we have what we call the pristine key buy setup. We have the setup. Now I want to cover a number of events that we can add to this to make it almost a 90% accuracy rate. Let's move on to those. The first event is what we call a narrow range day or narrow range bar. It is not something that I can put a number on. It is a concept that is measured entirely in a visual way. But the narrow range bar is very significant when it appears after a several day move in one direction or another. And a narrow range bar in general is simply this. The distance between the high of the bar and the low of the bar is smaller than, let's say, the last 4 to 5 trading sessions. That is a general or generic definition of a narrow range bar. Yes. The difference between the high of the day and the close, and the low of the day, the difference between the high of the bar and the low of the bar, that bar is smaller in its height than the last 4 to 5 bars. So if the last 4 to 5 bars were on average this size, this would be a narrow range bar. It's smaller than the last 4 to 5 bars from high to low. Now, narrow range bars are very significant if and when they occur after, that's the key word, after a significant several day move. For instance, a narrow range bar is very significant if I've got 3 to 5 consecutive days to the downside. 3 to 5 days of pain, now a narrow range bar forms. That is significant. And when a narrow range bar forms after a several day move to the downside, that is the sign that the stock should be ready to turn back to the upside. On the reverse side, if the stock has experienced 3 to 5 or more consecutive days to the upside, and then a narrow range bar forms after this move to the upside, this is a strong indication that the stock is poised to move back to the downside. One final fact to understand and definitely keep in mind about narrow range days is this, that moves that occur from narrow range bars tend to be far more explosive than moves from normal range bars. I want you to think of the narrow range bar like a Coke bottle that you shake up, and when the top gets popped, an explosion out of the bottle happens. That bar is contained with so much pressure that it acts like a spring that when released will have a violent move one way or the other. So moves that occur from narrow-range bars are far more potent than moves that occur from normal-range bars.
Does it matter if there are up days or down days on the narrow range?
Very good question. Does it matter if the narrow-range bars are dark bars, meaning they close below the open, or light bars? No. There are times when, whether they're light or not, we will anticipate the buy, but that's a different subject. Okay, now let's take the concept of the pristine buy setup, right? We know the pristine buy setup. Let's combine it with the narrow range day setup and see what we have. In this case, here's the pristine buy setup. I have 3 or more consecutive lower highs. In addition to 3 or more consecutive lower highs, I have a narrow range bar. Once I have this, if the stock trades above the narrow range bar, I am a buyer in an aggressive way. Because I am buying above the high of a narrow range bar, I am doubling my size. This is the way I trade. The presence of a narrow range bar with the buy setup increases the odds of success and increases the potential of the move. And I want to exploit that as much as I possibly can. So if I'm normally a 1,000-share trader, under this scenario, I become a 2,000-share trader. I do this because, again, there's typically a more explosive move, but more importantly than that, look at where my stop, let's move that up. Look at where my stop is. My buy is here. Where is my stop? Under the low of the narrow range bar. That, because it's a narrow range bar, it is very close at hand. Not only is this a potentially more profitable play, it's a lower risk play. And if it's a lower risk play, one can pick up the ante. You understand? You follow this? Now. So again, we have the pristine buy setup combined with a narrow range day. I am doubling my size. Yes, ma'am. That's the next event. Very good question. Am I looking for a pickup in volume on this narrow range day? I do not have to have a pickup in volume, but if I do, that even increases the odds. Let's move to that next. Well, let's look at an example first. Under this scenario, all of these are actually recommendations, by the way, in our letter. The pristine day trader or pristine light. Sky Mall Inc. Clearly shows a very powerful stock that made a new high. If you'll note, I want you to note how severe the drop was, simply because it was such an incredible exponential run to the upside. But there are some interesting clues in this chart. I want you to note how wide range the first few bars of the decline were. The high of this bar is near 45? The low of the bar is near 40. That's a $5 bar or more. The high of this bar is around 37, 38. The low of the bar is near 25. That's a very wide range day. Sellers are dominating the market activity. They are creating pain in the worst possible way. The third bar, what's happening? Smaller range. Sellers may be running a little bit out of selling ammunition. The next bar, a lot smaller than the first two bars still. The following bar, narrow range day. The sellers have used a lot of bullets to create this drop, and the narrow range bar signifies that they have now run almost virtually out of all of their selling ammunition. They can't create big down bars anymore. They're losing the momentum. They have no more bullets in the gun that they've been shooting. What's interesting on the following bar is we get another narrow range day bar. Guys, if one narrow range day bar is powerful, two is more powerful. Not only that, another clue is look at who won the second narrow range day. Who won, the buyers or sellers? So all of a sudden, the balance of power has shifted from the sellers, remember dark bars are controlled by the sellers, to the buyers. The buyers just took complete control of the market, and it happened to be on a narrow range day. My God in heaven. This stock is ready to explode. So we have the pristine buy setup, obviously, 3 or more consecutive lower highs, combined with 2 narrow range bars, in addition to buyers having taken control of the market. I am all over the stock once it trades above the prior bar's high. This stock rallies, 70% in 2 days. Yes, sir. My bar is on the big bar day. That was the first bar that traded above a prior bar's high. So my buy is there. You guys see that? The buy came at about $17.03 or so. I remember the play very, very, very accurately. Excuse me. That's actually very early in 1995, in January of 1995. This is an old example. Guys, Donaldson Lufkin, let's look at this. These are all actual plays, by the way. Here we have Donaldson Lufkin. Stock rallies to a new high. Note the tail, my friends, near the high. Tails at the top of the bar indicate that we have found the sellers. All right? Now I'm waiting for a small temporary period of pain. The stock experiences 3 or more consecutive lower highs and combined with a narrow range bar, but not only any narrow range bar, a narrow range bar that indicates what? The buyers have taken the market into its control. Remember, dark, 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 light. Narrow range bar, you're doubling your size. Once it trades above the prior bar's high. This is the entry bar, and look at the explosion to the upside. Once it trades above the prior peak here, I am in sell mode incrementally. Note the tail right at the top of the move. We have spotted the sellers. Once I'm out of the stock, I step back and wait for pain to start all over again. 3 or more consecutive lower highs, narrow range bar. Note this tail. Now I found the buyers. I buy the stock once it trades above the prior bar's high, another explosion. Guys, it is like clockwork, but this only works like clockwork as long as you are trading the concept on stocks that are making new highs or higher highs and higher lows. Once the stock fails to do that, kick it out of your universe. There is always something out there experiencing higher highs and higher lows. Yes, sir? Absolutely. Can you use it on an intraday basis? Yes. There are smaller periods of pain and smaller periods of greed. All right? That's all. We're playing fear and greed here. We're stepping in at the bottom of fear and stepping out at the top of greed. Yes, sir? Oh, absolutely. Absolutely. You just flip the criteria. Downtrend, I'm waiting for 3 or more consecutive higher lows on the, not highs, lows. Once the stock trades below the prior bar's low, I'm short with a stop above the prior bar's high. And I'm looking for the same criteria. Can you use this with options? Guys, we are playing people. You can use it with rocks, all right? It doesn't matter what they're trading, all right? If they're trading it, you can use it. We're playing greed and fear. And I will tell you, a lot of people ask, they say, Oliver, you're out there teaching everybody on planet Earth, and isn't that going to ruin the concept? No, it's not going to ruin the concept. I am not more powerful than fear and greed. I think those guys have been around for a very long time. And if I can single-handedly eliminate them, I tell you, I deserve great accolades, and I certainly don't deserve that. We will never be able to change those two dominant emotions. So let's profit from them. Yes, sir. Very good question. What if I'm salivating off this play? I'm saying, man, today, if it trades above yesterday's high, I'm all over this baby. And all of a sudden, the stock gaps up $4, and you're like, oh, my God. Well, there are specific intraday strategies we teach, one of which is called Pristine's 30-minute rule, which is to basically let the stock trade for 30 minutes. If after 30 minutes it can make a new daily high, it's a buy, with a stop below the current day's low. But that is an intraday trading tactic. Yes, sir. 3 or more consecutive lower highs, yes.
That one is only 2, right? And then 2 low and high.
This one is 1, 2, 3, 4.
Right. How about the next one? You see after that?
Oh, there's no, right, there is, in this case, there is no buy.
Okay.
There is no buy. Now, you've missed a run, absolutely, but I am telling you that if you stick to the 3, you will definitely more consistently pick off stock from people that are selling it at the wrong time. You start doing it on 1 and 2, and you mess with the odds. All right? This one tactic, guys, this one swing trading tactic, and there are several, this one swing trading tactic is enough to go into the market and make a living. Now, let me tell you how you structure your program, because I want you to start doing this on Monday, not Monday, but Tuesday morning in this case. And this is what you do. I want you to create your own stock universe. And if you happen not to have one, I will help you create it right now. You take every single stock in the Dow Jones Industrial Average. Then you take every single stock in the NASDAQ 100 average. And then you take every single stock, if you want a bigger universe, in the OEX or the S&P 100 index. You're going to have some overlap. Eliminate those. And this is a very nice universe that pretty much represents the market. Now, you will sit down with this list of stocks, and you will go through looking at each one on a daily chart covering about 4 to 5 months of data. I want you to look through every single one of these stocks through the eyes of a daily chart, and I want you to pull out any stock that meets the criteria of an uptrend, higher highs and higher lows. You will pull it out of the universe and drop it into a list that is called uptrend. Then I want you to find every single stock in that list that meets the specific criteria of a downtrend. I want you to pull it out of that larger universe, place it into a separate list called downtrends. Now you have 2 groups of stocks that will serve as your universe. Now, each and every day you must go through your uptrend list and your downtrend list to make sure that no stock in the list has violated the definition. If it has, kick it out. Kick it back into the major universe. Then you'll have to go through the major universe to make sure that no other stocks have started to meet the criteria of an uptrend or downtrend. This is your program. Now, let's say 10 minutes before the open, you flip on CNBC. Maria Bartiromo, looking very nicely on the floor of the New York Stock Exchange, is talking about how everything is down pre-market. Oh my God, it's the end of financial civilization as we know it. You are not afraid one bit. You say, thank you very much, Maria. You pull out which list? My downtrend list. But the downtrend list may be 10, 15 stocks. Then you say, well, of the stocks in my downtrend list, which ones do I want? Those that have rallied 3 to 5 consecutive days. Let's say in this scenario, 10, 15 minutes before the opening bell, Maria Bartiromo is very excited and looks particularly buoyant on this morning because everything is up. Everyone's crisscrossing on the floor of the New York Stock Exchange, knocking her left and right, because they're excited about the open. You say, thank you very much, Maria. I am ready for this. You pull out your uptrend list. Of those in your uptrend list, you are looking for those that have recently experienced a 3 to 5 consecutive down days. You pull those out of the uptrend list and you place them on the buy me today list. If they trade above yesterday's high. On this list of stocks, you place alerts right above or right at yesterday's high, and you wait. You let the market come to you. You have mapped out the plan. You have set the rules for the market. And when the market plays by your rules, there is not a moment's hesitation because you made the rules. There is no doubting because you made the rules. There is no hesitation whatsoever. The moment, the instant an alert goes off, you hit it, place your protective stop, and sit back and let magic work. This is playing the market. The problem with most individuals is that they let the market play them. If the market does not fall within your plan, you sit and read the paper. Understand? Thank you. Go make money.